The first indicator we're going to study in this section is the moving average, which is probably the most common indicator in trading. This indicator is simply an average of the prices over a certain period of time. Let's suppose that we want to calculate the average price of euro-dollar for the past 5 days. 4 days ago, the session closed with a price of 1.12. 3 days ago, it closed at 1.1205, then 1.1220, 1.1210, and today the price is 1.1215. The average is simply the sum of all the prices divided by the number of days. So we have 1.12 plus 1.1205 plus 1.1220 plus 1.1210 plus 1.1215. Everything divided by 5, and we have 1.1210, which is the average price for the past 5 days. Let's have a look at the moving average on a chart on TradingView. To add the moving average to your chart, you need to click on Indicators and then use the search bar to type Moving Average. There are several results, including exponential moving average and weighted moving average that I'm going to explain later on in this lecture. For now, we're going to choose a simple moving average, and then we close this window. Now you can see that you have an additional line on your chart. This is the moving average. On the top left, you can also find the indicator under the name SMA, which stands for Simple Moving Average, and you can hide it, check the settings, view the code, delete it, or more. I want to go to settings just for a moment because I want to temporarily set the period of the moving average at 5. So I type 5 here where we have length. So what does this line on our chart represent? It represents the average price for the previous 5 candlesticks. So if we hover over the line with the mouse cursor at this specific period in time, the line represents the average price for these last 5 candlesticks. You can read the average price on the top left, where the value of the indicator is displayed. In this case, the average price is 1.11853. What if we hover over the line here at this particular moment in time? Then the line here shows the average price for the previous 5 candlesticks previous to this point here. At this specific point in time, the average price was 1.09013. What does this mean? It means that the average price of this last 5 candlesticks is 1.09013. We have a current price of 1.09688 and a moving average of 1.09013. The current price is bigger than its average. In this case, we say that the market is trading above its average. If we go back in time to check another candlestick, for example this one, we can see that the price was lower than the moving average. In this case, we say that the market is trading below its average. Now, do you have to check the exact value of the average all the time? No, the convenient part about the moving average is that you have the line on the chart representing the average at any point in time. It is easy to see when the market is trading above or below the moving average. For example, here the market is trading above its average. All these candlesticks are obviously above the moving average. No need to check the exact value here on the top left. Why is it called moving average? Because the average moves with each new candlestick formation. So here the moving average is calculated considering these 5 candlesticks, but with the formation of a new candlestick, the average moves to include the new one and disregard the first one. Before checking how to use the moving average to make better trading decisions, let's have a look at the settings. Under inputs, the first thing that we can change is the length. The length represents how many periods you want to have in the calculation of the average. Suppose we are analyzing a daily chart. Length simply asks over how many days do you want to calculate the average. If we select 100, for example, it will report the average calculated on the last 100 candlesticks. There's no length that is better than another. It all depends on your trading style. If you are a short-term trader who likes to trade low time frames and take many fast trades, then a length between 15 and 50 may suit your trading style well. While if you tend to take long-term trades, then 100 or 200 can be a good choice for the length of the moving average. I must admit that no matter the trading style, I like to have a large parameter for the length of the moving average, because when you choose a small one, the moving average tends to be very close to the price, which doesn't really give any additional information. I like something like 100, so the moving average will calculate the average for the last 100 candlesticks and give more useful information about the trend. Again, it's a matter of preferences, but in this lecture, I'm going to set the moving average length at 100. The next parameter is source. As we have seen, a candlestick reports 4 pieces of information about the price: open, close, high, and low. With source, you can select what kind of price you want to use when you calculate the average. So if you select close, it will take the closing prices of the candlesticks in order to calculate the average. If you select open, for example, it will consider the opening prices of the candlesticks when calculating the average. You can see that you have many choices here. My suggestion is to stick to the standard one, which is close. Then we have offsets, which allows you to move the same indicator backwards or forwards. For example, if we select 20, you can see that the same moving average is plotted 20 candlesticks forward. This is a function that is used mainly by programmers to build new indicators. We are not going to use any offsets, so we go back to 0. Smoothing allows you to use a second moving average together with the one that we already have. Using 2 moving averages is a popular strategy among traders. You can Google moving average crossover strategy and you will find a lot of material on this popular way of trading. I'm not a huge fan of that strategy, but I wanted to share the name with you just in case you want to learn it and test it for yourself. Anyway, the parameters for smoothing are insignificant for us as we're not going to add a second moving average. You can see from the Style tab, the smoothing line is disabled. Going back to the Inputs tab, last parameter we can change is the time frame. Chart means that the moving average will be applied to the same time frame you have on the chart. If you're using a daily time frame to check the market, the moving average will be applied to a daily time frame, so each candlestick will be 1 day. Same if you use an hourly chart to analyze the market, the moving average will be applied to 1-hour candlesticks, and so on like this. If for any reason you want to have the moving average calculated on a different time frame from the one that you have on the chart, then you can select the time frame here, but I will suggest to keep this option as chart. There's also an option to select wait for time frame closes. This is useful if you have selected a time frame that is different than the chart. So if your chart has a 15-minute time frame, for example, and you have selected a moving average to be calculated on a daily time frame, then the wait for time frame closes option will not generate a new piece of moving average for every candlestick on the 15-minute chart, but it will wait for the time frame that you have selected for the calculation of the moving average. In this example, we said a daily time frame. So it will generate a new piece of moving average every day and not every 15 minutes, even if you have a 15-minute time frame on your chart. This is really advanced stuff, and you can leave this checked or unchecked. It doesn't make any difference if you leave the time frame as chart. I explain what this feature does because it only takes a few seconds for me, while if you had to Google it just out of curiosity, it would probably take half an hour to understand what it does. Okay, now it's time to check style. We have moving average, which is the line of the moving average we have on the chart. You can customize it, choose the color and the size you prefer. I'm not going to change anything, but this is really just a matter of preference. With this button here, you can also change the way you visualize the moving average on the chart. The standard way is a line, but you can also choose to have an area, for example, which, to be honest, doesn't look good at all. So let's go back to a line. Precision is about how many decimal points you want to have when viewing the value of the moving average. This does not make a huge difference as traders generally work with the moving average on the chart instead of checking the exact value of it, so I will leave precision as default. We also have labels on price scale and values in status line. Let me explain very quickly what they do. Labels on price scale allow you to view the value of the moving average on the right side of the chart. Now, we have this enabled, but we still don't see the value of the moving average here. We only see the value of the current price. Chances are that you have a setting disabled in the general settings. So right-click on the chart, settings, and then we choose scales. Here we enable indicators and financials value, and we can now see the value of the moving average on the right side of the chart. I don't necessarily want it there, so I'm going to disable this setting again. Then we have values in status line. The status line is the one here showing the name of the indicator and its value. If we disable it, we can see that when hovering over any part of the chart that includes the moving average, we don't have the value on the top left. Let's go back and enable it again. And now we have the value back in the status line. Regarding the visibility tab, I highly recommend to leave it like that. It's so easy to make a mess when changing something in the visibility tab, so just leave it like that. Okay, so here we have our moving average, 100 periods. The one we have here is a simple moving average. As we have seen before, there are also exponential and weighted moving averages. Both of them have a slightly more complicated formula that assigns more importance to recent candlesticks compared to the old ones. Generally, the difference between the three moving averages is minimal. I want to add the other two to the chart very quickly so you can see the difference with your eyes. I'm going to do it very quickly and also change the length of the other two to 100 to match the simple moving average that we have on the chart. Alright, we have all of them here. You can see that there is a difference between the three moving averages, but not a huge one. The main difference is that the exponential moving average, just like the weighted moving average, accelerates faster in case of strong trends. This is because they assign more importance to new candlesticks, so when a new trend forms, it gives a bigger boost to the exponential and weighted moving averages compared to the simple one. I believe that the most used one by traders is the exponential moving average, but feel free to play a bit around with them and use the variation that you prefer. For the purpose of this lecture, we're going to use the simple moving average, so I'm going to delete the other two. Finally, the big question, how to use the moving average. There are so many different ways to use the moving average and include it in your trading strategy. One way has been already mentioned before, the crossover between two different moving averages, which is not something we're going to use in this course. Another popular way is to look for undervalued assets below the moving average, which is a popular approach in stock trading, but not so effective in forex trading. Really, so many different ways to use this indicator. That is why this is the most popular indicator out there. The one I want to show you here is how to use the moving average to identify trends. There are two very powerful criteria to define a trend using the moving average. The first is the position of the price in relation to the position of the moving average. If the price consistently stays above the moving average, we have an uptrend. If the price consistently stays below the moving average, we have a downtrend. If the price is crossing the moving average several times without consistently staying above or below it, we have a sideways trend or an unclear trend. When I say consistently, I don't mean that all the candlesticks in an uptrend have to be above the moving average or below the moving average in a downtrend. Not all of them, but the majority of them. So this is the first criteria. We're going to have some examples on the chart very soon. The second criteria is the slope of the moving average. The slope of the moving average refers to its inclination angle, which can be upward, downward, or flat. If the moving average has an upward slope, which means that it's rising, it is usually a sign of an uptrend. If the moving average has a downward slope, which means that it's falling, it is usually a sign of a downtrend. If the moving average is flat, it usually means that we have a sideways trend or an unclear trend. Now, let's put these two criteria to work and identify some trends on the charts with the moving average. Here we have euro-dollar on a daily chart, and it's your turn to analyze the trend. Feel free to pause the video, go back to check the two criteria to identify the trend with the moving average, and then analyze the market. You can also write down your analysis and compare it to the analysis I'm going to conduct in a few seconds, so you will have an idea about whether you're moving in the right direction and you're getting better at analyzing the market, or maybe there is something you should review. Okay, so the first criteria is about the position of the price in relation to the position of the moving average. After we have the crossover here, the price stays almost always above the moving average. So according to the first criteria, the price might be in an uptrend right now. The second criteria is about the slope of the moving average, so simply in which direction the moving average is heading. We have a similar scenario here. Before the breakout, the moving average seemed to have a downward slope, but after the price breaking through it, the moving average started to go up, and it kept an upward slope for almost the rest of the chart. So we have both criteria suggesting an uptrend. But that's not the end of our analysis, because I believe it's worth mentioning that this area here is a bit of a gray area. You can see that the price breaks through the moving average and stays below it for a while. The moving average is kind of flat here, so not going up anymore. This is an area in which it is perfectly normal to have some doubts about the trend. I myself would have not traded in this area here. We have had a clear uptrend before this area, which means many opportunities to open long positions and make money. We also have an uptrend resuming after this unclear area, so other opportunities to open long trades and make money. So I invite you to trade only the market situations that are 100% clear to you, because generally in trading, simple means profitable. Let's switch to another chart. We have the chart for gold on a 4-hour time frame, and I'm glad to analyze a commodity such as gold because I want to show you that our approach follows trading principles that can be applied to most of the financial markets and not just forex trading. I'm sure you wouldn't believe me if I told you how many times I have received the questions, what do you think about gold? Is it going up or down? Is it a good time to buy? So now let me take my revenge. Now it is me going to ask you these questions. Based on the chart you have here, when is it a good time to buy gold? Would you buy it at the beginning of the chart, in the middle of the chart, or in the last part of the chart? This chart is actually quite interesting as we have three kinds of trends. In the first part of the chart, the price is going down. This is also confirmed by the moving average, as the price consistently stays below the moving average and the moving average is going down. In the middle of the chart, we have a sort of sideways trend, or at least an unclear trend, with the price crossing the moving average several times and the moving average being flat most of the time. In the last part, we start to see an uptrend, with the price staying consistently above the moving average and the moving average going up. Of course, you want to buy when the trend is in your favor, so the right answer is that you want to buy in this last part of the chart. Now, you may ask, okay, I understand it's better to buy in the last part of the chart, but when exactly? This is a good question, because recognizing the trend is just part of the job. Then if you want to be a profitable trader, you also have to place a good entry and good stop loss and take profit levels. But don't worry, this course covers all the aspects of trading. In fact, in the next lecture, we're going to have a look at an indicator that will give you lots of precious information on when exactly to enter your trades.